Have you ever looked at a company's balance sheet, the P&L statement, and thought, hmm, this doesn't feel like the whole story, especially now?
Oh, absolutely. It often feels like you're missing something vital.
It's like, yeah, trying to navigate a super complex modern business with, I don't know, an old paper map.
Exactly. A very outdated map.
So in this deep dive, our mission is to explore a couple of, well, potentially radical new systems designed to give us that clearer, maybe more holistic view.
That's spot on because, traditional financial systems, they're mostly historical snapshots,
Right, looking backwards.
and they focus primarily on just the monetary stuff, dollars and cents.
Hmm.
They often, well, they struggle to capture the value of intangibles or a company's real environmental impact or even just how adaptable it is.
Which is crucial today.
Absolutely crucial. So today we're diving into two big ideas. The value flow statement, let's call it VFS, and the dynamic risk and opportunity ledger, or DROL.
VFS and DROL.
And these aren't just like minor tweaks. They could fundamentally change how we size up a company's health.
Okay, let's unpack that. Starting with the first one, the value flow statement, VFS. How does that actually change the game, how we view performance?
Well, the fascinating thing about VFS is how it shifts the focus.
Yeah.
It's all about how a company creates, transfers, and importantly, retains value.
Value in a broader sense.
Exactly. Both financial value and non-financial value over time. So it's not just revenue.
Oh.
It looks at things like growing intellectual capital, patents, unique software, that sort of thing.
Intangibles.
Right. And also how value gets distributed, wages, taxes, community investment, and then what's kept back, reinvested in R&D, for example.
Got it.
But here's a really key part, especially for you listening. It introduces this idea of value leakage.
Value leakage, what does that mean?
Think about, say, a fast fashion company. Value leakage wouldn't just be wasted fabric. It could quantify the financial hit from their carbon emissions.
Oh, okay.
Or even, reputational damage if they have poor labor practices. These are real costs, but traditional statements. They often miss them entirely.
So VFS tries to capture those hidden or maybe ignored costs?
Precisely. It gives you that truly holistic insight. It aligns really well with sustainability goals, ESG reporting.
Makes sense.
And it's fundamentally forward-looking. It emphasizes future potential, not just past results.
Okay, but hold on. If VFS shows this value leakage, fixing that, say, investing in greener processes might make a company look worse financially in the short term, right? How do investors handle that?
That's a really sharp question. And yes, initially the numbers might reflect that investment. Could be. But the VFS framework really pushes the idea that fixing leakage builds long-term sustainable value. It actually reduces future risks.
So it's about shifting the perspective.
Exactly. Shifting the investor mindset away from just chasing quarterly profits towards understanding sustained value generation. Super important for, say, green tech or social enterprises.
Right, that makes a lot of sense. Okay, so if VFS broadens the view of value, then this other one, the dynamic risk and opportunity ledger, DROL, sounds like it's about moving beyond static pictures, more real time.
You've got it. It's all about dynamism. Forget just fixed assets and liabilities. DROL is constantly mapping a company's risk exposure and its opportunity landscape.
Across everything.
Pretty much, yeah. Operational, financial, strategic risks, external factors. It bundles things like risk registers, quantifying potential disruptions, maybe supply chain issues or reputational hits.
Okay.
Alongside opportunity profiles, which detail things like innovation pipelines or new market entries.
So threats and potential upsides, side by side.
Yes, and crucially, it adds volatility projections. Stress tests, basically. What-if scenarios. And liquidity and flexibility index. How fast can the company adapt its resources?
So it's constantly updating.
That's the dynamic part. It adjusts almost in real time to market shifts. Think about a tech startup needing to pivot fast. DROL could show them if the potential opportunity profile of a new market actually outweighs the risk register of their current product failing. It helps them shift resources now.
Making decisions based on current reality.
Yeah.
Not last quarter's report.
Exactly. It's built to foster genuinely risk-aware, agile decision-making.
Okay, so we have VFS looking holistically at value and DROL giving this dynamic risk and opportunity view. How do they fit together?
Yeah.
And how are they truly different from the old balance sheets and P&Ls?
Well, think of it like upgrading from just a rearview mirror to a full forward-looking dashboard.
A nice analogy.
Traditional systems, they're basically historical.
Yeah.
and almost purely financial.
Right.
The VFS broadens that scope: financial plus non-financial value, human capital, brand equity, environmental impact. It looks at ongoing performance and future potential. And it's more inclusive, considers investors, sure, but also society, the planet.
And DO.
DROL's focus is more on time orientation and agility. It's forward-looking, real-time insights into risk, strategy, flexibility. It really empowers managers, analysts, investors to make immediate, strategic, risk-informed choices.
So they're both offering something traditional accounting just doesn't.
Fundamentally, yes, they offer adaptable, strategic decision support that backward-looking accounting simply can't provide for today's economy.
So wrapping this up then, it really sounds like these systems, VFS and DROL, are trying to capture the messy reality of modern business. Stakeholder expectations, future readiness, stuff that traditional reports often gloss over.
That's the core idea. They aim to reflect that real-world complexity. And, it leaves you with a pretty interesting question to mull over.
Oh, yeah.
Think about it. How would your own understanding of a company's health really change if you saw its financials through this lens of value flows and dynamic risks instead of just assets and profits on a page?
That's a powerful thought.
It really makes you wonder, doesn't it, what other traditional metrics might actually be limiting our view, not just of companies, but maybe of the world?